So how do you possibly retire in a down market? Now, I know many of us are concerned by the recent bank failure of Silicon Valley Bank. And I'm sure many of us are thinking, here we go again. I know that I have many clients who may have anxiety at this particular time as well. That is why I decided to do this very, very important Tuesday tip on how to help you understand how you can retire even in a down market. So stay locked in. Hi, my name is Carson Graves, certified financial planner and president and CEO of the Retirement Education Center, and I want to welcome you once again to our Tuesday tip. Now, today what we are going to be discussing is how do you retire during a down market? Now, I surely hope that if you're investing in the marketplace, the stock market, I hope that you clearly know that from time to time, there are going to be times where the market is going to capitulate. There are going to be black swans that enter into the marketplace and it's going to blindside everyone. Now, when that happens, you have to understand how to navigate that particular situation. Now, if you're going at your retirement planning by yourself, it's going to make it very difficult for you to manage your emotions. That's why we're going to always encourage you to seek out a professional financial advisor that can help you navigate your emotions during a down market. But today, let's talk about 3 important tips that I give to my clients that would absolutely help you also manage your retirement in a down market. Now, the very first thing that I need to educate you on today when we're talking about a down market is understanding the importance of sequence of returns risk. Now, I always cover this particular subject matter in the classes that I teach. And of course, I'm always going to help my clients understand this as well. Now, if you're working with an advisor and you've never heard of sequence of returns risk, that is an issue. And it's good that you're actually tuning in today. So what exactly is sequence of returns risk? Basically, when you're talking about sequence of returns risk, it's when you actually have negative returns at the start of your retirement from the stock market. And you couple that with the combination of you taking withdrawals out of your account during that same time period. And of course, that can leave your retirement savings vulnerable to not last throughout your retirement years. So to quickly illustrate the importance of understanding sequence of returns risk, if you can see on the screen here, I have a really quick illustration that I would like to show you and help you to understand. Imagine having a $500,000 portfolio. You have portfolio A and portfolio B. They have the exact same returns, they're just inverted. They're taking $25,000 out annually, and they are increasing that $25,000 by 3% annual for inflation, okay? So if you're looking at these returns, you can pause this video and come back to this later. You can see that they have the exact same returns, except portfolio A has an increase or a positive return of 33% in year 1 versus a downturn or a negative return in the marketplace for portfolio B in year 1. In year 20, portfolio A has the negative return of 28% and portfolio B has a positive return of 33%. I'll remind you, they're taking out the exact same amount annually and increasing it for inflation of 3%. This portfolio for portfolio A, simply because they had a positive return in the marketplace in the first year of the retirement, in year 20 still has about $1.5 million remaining to take from their portfolio. If you look at portfolio B, at around year 18, they are completely out of funds for retirement. So you have to understand the importance of sequence of returns risk when it comes to a down market and how to navigate this and eliminate this from your retirement portfolio. Now, with that being said, I have 3 important tips that I want to share with you that I think that can help you in any type of market. The first tip that I want to give you is do not panic and sell your holdings. This is the cardinal rule of investing. You don't want to buy high and sell low. Many people are doing that right now. They are going to be selling out of their holdings, and that is ill-advised. You should not be doing this. One of the things to understand is that bull markets last anywhere from 4 to 5 years on average, as opposed to bear markets lasting on average of about 9 months. So which market do you want to participate in? So I want us to consider the financial crisis of 2008. I know many of us remember this time frame. It was one of the worst financial crises since the Great Depression. Someone with 50% in stocks during that time frame who retired with $1 million in 2007 and spent $40,000 annually adjusted for inflation. After 2 years in that particular market, they would have had about $874,000 remaining for their retirement savings. But if they had remained in the market until today, that same portfolio would be valued at about $1.6 million today. So just imagine that. This person actually sticking with their portfolio plan and not selling out at an ill-advised time would still, in one of the most devastating stock market crises since the Great Depression, have more in their retirement savings than what they started with, simply by sticking with their guns and not selling out in a down market. Now, my second tip that I want to give you is that you want to make sure that you cut spending in a market decline. Why do I say this? If you're overspending in your portfolio in a market decline, it's going to leave you with less money in place to grow when the market actually turns around. So you want to make sure that you do not overspend and you actually start cutting spending. One of the things that you might want to do is not adjust your income for inflation. I always tell people to consider the 4% rule. The 4% rule states that you're going to start out with a certain amount of income from your portfolio. You basically have $1 million, you multiply it by 4%, saying $40,000 a year. If we have inflation, you will increase that $40,000 a year according to inflation. During a market decline, you should not do that. You're going to have to maybe hold on and just continue to take that $40,000 per year so you don't risk running out of money during that time period. Another thing that you may want to look at, if you have the opportunity to do so, perhaps you're still working, maybe part-time, maybe adding to your retirement savings at that time. Why? Because the market is on a discount. For whatever reason, many people like to run from a down market, but any other place in your life, we run to a discount. If it was retail, if you were buying a car or a foreclosed home, people like to run to those things when they're on a discount, but they run from the stock market. It works the exact same way. So you want to make sure that if you have the opportunity in a down market, go ahead and add to your portfolio savings, because when the market turns back around, as it will, you will have owned more shares in that particular portfolio than before at a discount. And one of the things that I think that people may not think about during these times is that they can convert their IRAs into a Roth IRA during these times because the market has depressed that particular portfolio. Now, I'm going to illustrate to you why this can be an important strategy for you to give you some tax-free dollars going forward in your retirement. Take a look at the illustration that we have on the screen here. If you're taking a look at a portfolio, hypothetical portfolio of $500,000, let's just say you wanted to convert 50% of this particular portfolio. If you're in the 25% tax bracket, that is going to cost you about $62,500 to convert this portfolio at that time at 50%, $250,000. Well, let's say the market actually is down and you still have the same idea that you want to convert 50% of your IRA into a Roth IRA. Well, when the market is down, you're converting 50% of a $350,000 portfolio, which is going to actually save you in taxes, because now that same conversion is only going to cost you $43,750. That is an $18,750 savings in taxation of converting at a down market. And guess what happens? When the market turns back around, those funds that you converted now can continue to grow, but they're going to grow tax-free, and you can take the money out tax-free as well. And the last point that I want to leave you with when understanding how you can retire during a down stock market is to understand how to manage volatility. Now look, volatility is going to be in the stock market, but there are ways that you can manage it. One of the things that you may have to do is reduce your equity exposure. Now, if you're retiring and you have maybe 70 or 60% of your portfolios in equities, you may want to dial that down to a 50% holdings in your equities, maybe even 40%, or even lower, in order to manage the volatility that may be taking place in a down stock market. The next thing that you also need to consider are annuities. You have to consider annuities. You have to quit running from annuities, everyone, because annuities can completely protect you from a down market. Guess what? Imagine if you're in this market right now and you have $200, $300, $400, $500,000 sitting inside of a guaranteed fixed annuity. You haven't lost one dime of your money. Doesn't matter what bank is collapsing. You haven't lost anything. You may want to consider other defensive strategies as well, like CDs, cash, or even structured notes can be a very important tool in your portfolio in a down market. If you don't understand how to allocate into some of these type of vehicles, then I highly encourage you to utilize the links in our description below and schedule a 1-hour free consultation with myself and our team so we can perhaps help you figure out how to better manage your portfolio during the down stock market as well. And the last thing that you can consider to manage your volatility in a down market is to just use other assets. If you have the ability to do so, you may want to look at a reverse mortgage or even taking a loan out of a whole life insurance policy. These are a couple of different ideas that you may want to explore. You have to get educated, of course, because it's not a one size fit all and everybody may not be suitable to do any of this. But if you speak to a qualified financial advisor, you may be able to assist yourself in a down market by utilizing other assets and allowing your equity portfolio to recover while the market is actually down. So these are some ideas that I really hope that you can take to your bank and end up riding out a down market even during your retirement years. So I really hope that today's Tuesday tip will give you some ideas on how to retire even in a down market. Please understand that these videos are created for educational purposes only and that you should always seek out your own financial advisor, your own attorney, and your own tax advisor regarding your personal situation. Also, if you are looking for a fiduciary financial advisor to help you with these type of complex financial matters, we highly recommend that you utilize the links in our description below. Go ahead and schedule a 1-hour free consultation with us today. And if you found this information to be beneficial, we simply ask that you subscribe to our channel, like this video, and share it with others.